we are launching the Global Financial Stability Report. Let me give you a couple of headline messages from the report. Our baseline assessment for global financial stability is that risks have been increasing. And there are really two main factors here. One is that the overall level of policy uncertainty has increased. And the second factor is that the forecast of economic activity going forward is slightly lower. Pierre Olivier was presenting the World Economic Outlook just now. So it's a combination of a lower baseline and larger risks that has been increasing the downside risks. Having said that, we do see both downside and upside risks, and we'll certainly explain more about the two sides of uncertainty throughout the conference. So let me highlight three vulnerabilities that are driving our assessment. The first one is the level of risky asset values. We've certainly seen some adjustment in risky asset values. It's important to see that in the broader context of where we're coming from. In recent years, we saw quite a bit of appreciation, particularly in equity markets and particularly in some sectors such as technology, so that valuations were quite stretched. Credit spreads were, very tight by historical standards. And we have certainly seen some decline in valuations, but by historical standards, price-earnings ratios, for example, in equity markets continue to be fairly elevated. Credit spreads and sovereign spreads have widened to some degree, but they are still fairly contained by historical standards. The stretching of asset valuations continues to be a vulnerability we're watching closely. The second vulnerability is about leverage and maturity transformation in the financial system. And, that's particularly in the non-bank sector where we're looking closely as to how leverage is evolving. As market volatility has increased, we have seen some degree of deleveraging, but market functioning has been sound so far. So with higher volatility, we would expect asset prices to come down. But the functioning of how those asset prices adjusted has been very orderly to date. The third vulnerability that we are watching is the overall level of debt globally. In the past decade, and particularly since the pandemic in 2020, sovereign debt levels have been increasing around the world. And it's the backdrop of higher debt that can interact with financial stability. And that's particularly true for emerging markets and frontier economies, where we have certainly seen some widening of sovereign spreads. Issuance year to date has been strong, but of course the tightening of financial conditions that we observed in the past 3 weeks has an outsized impact on those more vulnerable countries. Starting with the second part of your question, we have seen a strong rally in gold prices, which is the sort of usual relationship we see in safe haven flows when there is a high level of uncertainty. Risky assets are selling off. Oftentimes, gold is viewed as a hedge asset and has been appreciating. Concerning U.S. Treasuries, of course, U.S. Treasuries remain the baseline reserve asset globally. It's the largest and most liquid sovereign market, and we have seen yields move. They have been increasing in the past 2 weeks, which is somewhat similar to the episode in 2020 when longer duration assets had yields increasing as well. What is somewhat unusual is that the dollar has been falling to some degree, but it's important to keep that in the context of a strong dollar rally previously. Concerning the emerging markets and frontier economies, yes, tightening of global financial conditions has an outsized impact on weaker economies. And we have seen a number of weaker emerging markets and frontier economies with high levels of debt. We have seen issuance throughout last year and earlier this year, but tighter financial conditions certainly adversely impact the financing conditions for those countries. Let me take this in three parts. About the strength of the dollar and the impact for emerging markets. So when we look at exchange rates relative to emerging markets, there's some heterogeneity. So, the dollar has appreciated against some emerging markets and depreciated against others. But it's not the only impact on those financing conditions. We certainly have seen a notable widening of financing spreads, and that is probably the more important determining for external financing conditions in emerging markets. Now, having said that, in some of the larger emerging markets with developed local government bond markets, we have seen some inflows into those local markets, but it's very country specific. Turning to the question of investment decisions, we think that the first order impact here is the overall level of uncertainty. So, generally investment decisions are easier in an environment with certainty. So given that there remains some uncertainty about how policies are going to play out going forward, that can be a temporary headwind to investments or merger activity.
I think during periods where markets are volatile, it's reasonable that market participants and investors demand more liquidity, thereby moving in cash, right? We have not seen this happening en masse so far during this episode. So we have seen bank deposits increase a little bit in the United States, but I think the magnitude is significantly smaller compared to previous episodes of stress.
The International Monetary Fund has been advising central banks for many decades, helping central banks in terms of governance and monetary policy frameworks is really one of the core missions of the IMF. And we have seen time and time again that central bank independence is an important foundation for central banks to achieve their goals, which are primarily price stability and financial stability. So we do advise our membership to have a degree of independence that is aimed at achieving those overarching goals for monetary policy and financial stability policies.
In the case of Nigeria, macroeconomic performance have held up, right? GDP growth has been fairly consistent and inflation has been coming down. And earlier this year, we have seen Nigerian sovereign credit spreads lowering. I think the reforms that authorities have done, including the liberalization of exchange rates, has helped in that regard. That said, I think I want to go back to the theme that Tobias has mentioned, which is that during a time where global financial markets is volatile and risk appetite in particular is wavering, this is when we might see increases in sovereign spreads that will challenge the external picture for Nigeria as well as other frontier economies. So, for example, Nigeria's sovereign spread has increased in recent weeks as stock markets globally has declined. The other challenge, of course, is for large commodity exporters like Nigeria. If trade tensions is going to lead to lower global demand for commodities, this will obviously weigh on revenue that it will receive. So I think both of those, developments would counsel that authorities remain quite vigilant to these developments and take appropriate policies to counter them.
We're working very closely with many sub-Saharan African countries to support the countries either via programs or via policy advice and technical assistance, to have a macro environment that is conducive for growth. So let me mention three things. So I think the first one is to recognize that we have been through a period of extraordinarily adverse shocks, particularly in sub-Saharan Africa. The pandemic had an outsized impact on many countries. The inflation that ensued was very costly for many countries, particularly for those that are importing commodities. So the adverse economic shocks have been extraordinary. And I would just note that we have, engaged more actively in programs with sub-Saharan Africa in the past 5 years than we ever did previously. The second point is about the financing costs. And of course, there are two main components. So one is the overall level of financial conditions globally. All countries in the world are part of the global capital markets. And, that really depends on overall financing conditions. But more specifically, of course, there are country-specific conditions, the macroeconomic performance of each country, the buffers in the countries, and that is really the mandate of the fund is very much focused on this macro financial stability. So getting back to a place with buffers, which then can lead to lower financing costs, is the main goal. And our work with those countries is very much focused on the kind of catalytic role of the fund, where we are trying to get growth back and stability back.